Well, hello and good evening. I want to welcome all of you to the group's annual real estate forecast. My name is Brandon Wells, CEO of the group Real Estate, and I want to thank you all for carving out time out of your evening to be here with us tonight. Real quickly, I'd like to know how many of you are returning and have been to a group forecast before. Would you please raise your hand? Awesome. Well, I want to thank each and every one of you for returning. Hopefully you'll find tonight's information valuable. Thank you for entrusting us to share our insights and for carving out time of your evening. How many of you are first-timers, have never been to a group forecast? By a show of hands, please raise them. Great. Well, thank you guys for being here. We really appreciate you. We hope that you learned something. We hope you gather some insights. I'll lay a little bit of the framework tonight for you of how we flow through the forecast. In order to kind of get an accurate perspective of what 2026 will look like, we need to understand what happened in 2025. Tonight, as I go through the information, I want to make note that all of the slides, all of the materials that you'll see here will be made available to you at the end of the presentation with a QR code. So if you miss something, you don't have to take pictures, you'll have access to all of that. I also am going to make a promise to you. It is really easy to get started and start reading every single piece of data and statistic that is on the screen. I promise you I am not going to do that tonight. You are all very intelligent people. You'll be able to see what is up there. We do have people that travel from all over our region, from their different cities, towns, municipalities, and I want to make sure that you know that there is information across all of them, but you'll have access to them. I'm not going to touch on every key data point, but I will cover some of the key themes that I want to call out and point out to you. So we're going to get started by looking at our region in 2025 by county, and we're going to go through that market performance. So I want to start off with Larimer County. And when we stood here last year, we talked about, a more moderated, stable real estate market without crazy amounts of growth in sales or really in price movement. And I think that's what we found. However, we did see our region show incredible resilience. Larimer County was up 9.7% in single-family home sales and saw a slight decrease of 1.1% in condo and townhomes. I call that out because we certainly saw some pressures on the condo and townhome market. A lot of that was driven in due to increasing HOA costs, insurance costs, rising inventory in that space. Median price, you can see that there, relatively flat, down a little bit more in condo and townhomes, down 1.2%. And then on the far right, you can see the distribution of closed sales, how many of them were condo and townhome versus single family. I will point out the data on this slide. It's 79% single family for Larimer County versus 21% condo and townhome. Moving on to Weld County, you saw strong performance, an increase by 4.64% in single family sales, slight decrease in condo and townhomes, fewer attached properties in the Weld County region, but an increase, slight increase in median price, rounding out at about $515,000. Moving on to Boulder County, so we'll go a little bit further south. We saw also an increase in single-family home sales of about 4.8%, flat across condo and townhome sales, as well as median price, and then just slight decrease in single-family home price in that region. Now let's look by each one of our towns, counties, and municipalities. I'll focus here on Fort Collins. Ended the year at a median sales price for single family of $625,000, relatively flat as we had projected. You see that same trend line with condo and townhome market. There is a few exceptions to that. Windsor saw an increase in price in the condo and townhome segment, up 4.64%. And then Greeley-Evans saw a 6% decrease, just fewer available condo and townhome units in those communities. You find that there's more single-family opportunities, more rural properties, but did see growth of just shy of 2% in Greeley and Evans on single-family median price. We'll go down to Timnath, Wellington, Berthoud, and Johnstown. Timnath saw strong growth in both sectors, median price increasing on condo and townhomes by 6.18%. And then single families up 5.19%, rounding out at 725,000 for Timnath. Slight decreases in Wellington in both, sub 500 for single family residents in Wellington. So a more affordable marketplace when you look at our region, similar to Greeley. And then down south in Berthoud, increase in condo and townhome of about 2.79%. I want to point out a couple of things with regards to Johnstown. So you see single family prices were down about 2.86%. Last year at our forecast, I talked about primary growth areas of new construction. Johnstown was really an anomaly last year, and as we had predicted, really strong sales growth driven by new construction. That market saw sales increase by 29% in 2025, just showing how growth in that opportunity at more affordable prices than some other regional areas is really a driver. Although prices didn't change much, there was a lot of competition between resale and new construction, but it did grow significant increases in total number of sales. Looking at Meade, Milliken, Longmont, and Boulder, much followed the same exact trend line that we saw. I will point out, because it always gets people's attention, single family properties in Boulder ended the year at a median price of about $1,275,000. That was down 3.77% year over year. Alt, Eaton, Kersey, and LaSalle, not much condo and townhome opportunities in those marketplaces as they are more rural, down about 7.11% in condo and townhome, but saw pretty good growth in terms of single family, just a little bit above 475,000. And then Estes Park out to the west, saw just shy of a 5% decrease in condo and townhome sales and rounded out single family median price at about $775,000, which was down 6.63%. Steamboat Springs, so the group operates an office up at Steamboat Springs. I thought I would just share some data. A lot of people like to recreate there, like to take trips up to Steamboat. Condo market was down just shy of 5%, but $880 was the median price. Townhome market was fairly strong, up 6.3%, and then single family was down 3%, rounding out a median price of $2,095,000 in Steamboat Springs. One of the things for those of you who are a little bit more visual, the group will continue to produce this starting this year of giving something that you can see on a more map basis. So if you're interested in understanding what's happening with median prices across our region, we'll share with you where you can find these resources. We often get a lot of people who are relocating to northern Colorado, don't quite understand where all the cities, towns, and the layout is. This is a little bit more of a visual representation of what does it cost to live in each area of our northern Colorado region. We also have this broken out by condo and townhome as well. The next thing I want to move into is, anytime we talk about pricing, and what is happening with pricings, yes, we focus on median price movement, but more so at the group to forecast the market, we look at price appreciation as measured by FHFA. Now this is by MSA, this is Fort Collins and Loveland, and this is going all the way back to 1978 through the third quarter of 2025. Our average annual appreciation is about 5.6% for this MSA. And this year, through 3 quarters, we've seen 2.8% appreciation in our market. I've talked for the last 2 years about expectations should be set that we are going to be below historical averages for appreciation. And I expect that same trend line to continue in 2026. And I'll talk more about the forecast, but recoveries and turns in housing markets are not quick and swift. They are slow and steady, and that is what we continue to see. Going to Greeley, let's focus on Greeley here. This goes back to 1984 for the Greeley MSA through 2025. And Greeley currently sits through 3 quarters at 1.2% appreciation, a little bit behind the Fort Collins and Loveland MSA, but I do expect that fourth quarter to be fairly strong. We saw a surge at the end of the year of improved interest rates, buyer demand, loan applications, and it drove a lot of activity. But I would expect under the 5% average annual appreciation to continue for 2026 for Greeley. I want to talk about, though, some positive things because there's a lot that I think gets lost in a lot of the noise and the negativity, and that is the strength and the resilience of our housing market. Oftentimes, we get lumped into national headlines about Colorado having a very challenged or difficult market. I will tell you, yes, there are parts of Colorado, but the Fort Collins, Loveland MSA, and the Greeley MSA, if you compare it to Boulder, Denver, Colorado Springs, Grand Junction, and Pueblo, we are outperforming every other region. And that to me shows incredible strength, not only in a more subdued year, but moving forward, I expect that to continue. Larry Kendall and I have a conversation very regularly about how anointed of a real estate market this is. This market has continued to endure the Great Recession and weathered that really well comparatively nationally, as well as the current circumstances. We continue to see strong performance in our region, and I think that's amplified here in looking at 2025. I'll point out in Fort Collins and Loveland, you notice that 3 consecutive quarters of positive appreciation, where almost every other region in the state had some variance of quarters that were negative. And I think that shows the strength of our housing markets up here regionally. Let's look at total number of annual closed sales real quick by the 4 primary markets here: Fort Collins, Loveland, Windsor and Severance is lumped together, and Greeley and Evans. I'll focus here on the 5.5% growth of sales compared to 2024 for Fort Collins. Loveland saw 5.7% increase in sales year over year. Windsor and Severance was up 6.2%, and Greeley and Evans was up 2.1%. So good growth and, like I said, steady recovery in that market. If we look at our entire northern Colorado region, and we exclude Longmont, Boulder, and Estes Park from this, but we saw 5.3% growth in home sales in 2025, ending the year at 8,939. And I put that just little reflection of, we reached kind of the low point in 2023, and we've been on this steady climb and recovery back out. I do expect that trend to continue. The National Association of Realtors is projecting nationwide an increase of 14% in home sales for 2025. I expect positive growth in our region, not of that magnitude, but I do see us continuing to gain closed sales across the area. So let's talk about our forecast for this year, and let's first see how we did in terms of our accuracy last year. Last year, we predicted that there would be 8,750 home sales across the region. As you just saw, 8,939 occurred. We were 98% accurate on that forecast projection. For next year, we're projecting 5% growth for the region, ending the year at 9,385 home sales for 2026. Let's talk about median price. Last year, we projected we would end the year at $524,000 would be the region's median price. It actually ended at $521,500. We were 99.5% accurate on that prediction. We see growth in price of about 1.44% for next year, ending the year at $529,000 is the region's median price. So the one thing that drives real estate is change. And I want to talk about some of the changes that we see that are impacting as we move forward into 2026. The first is this idea of the market is thawing. Many economists, many realtors would say that the last 2 to 3 years has been this period of kind of a deep freeze. where a lot of people were rate locked or had a 3% mortgage rate that said, hey, I'm not moving, I'm not going anywhere. And just buyers were priced out because they couldn't get financing terms that worked for their budget. And the market was kind of frozen. We see a lot of things happening and turning a new page of this market is thawing, and we'll continue to see it thaw throughout this year. One of the biggest changes is that movement of outstanding mortgages. And I want to point you to two things here. At the top, 20% of outstanding mortgages currently in the United States have below a 3% interest rate. You go all the way to the bottom, 21% now have an interest rate that is over 6%. So that kind of inverse of that is the thawing effect. More and more people are trading life for the interest rate. Now, things happen. People have children. People change jobs. They have to relocate. Divorces, deaths, all of these things represent change. And we are continuing to see people not necessarily be frozen by rates, but saying, hey, the change is indicating I'm going to move on, and more people are adopting that. I'll also point out here that rates between 5 and 6%, there's very limited representation, and that's because rates grew so quickly that there are very few people hold a rate between 5 and 6%. I expect that to grow with refinance opportunities through this next year. There is a psychological barrier that exists with the 6% interest rates. We just saw this because rates hit a 3-year low, and everybody was, all realtors and everybody was shouting from the streets. We saw a 5 at the beginning of rates. We saw a flash of a 5. That really does have a psychological impact on buyers in the marketplace, and it also has a psychological impact on sellers who may have been sidelined that are interested in re-entering the market, and we see that as a trend that will continue and improve the stability of our market moving forward. The next change I want to talk about is the number of Americans that are living mortgage-free. We hit a record high this year of 40.3% of U.S. homeowners do not have a mortgage. That represents incredible mobility and the ability to deploy that cash. And so when people say, hey, the doom and gloom or the naysayers say there's no movement going to happen, these markets are in trouble, well, guess what? There's a lot of people that are not reliant on interest rates to make those changes and move. Colorado has about 29 to 31% of homeowners are mortgage-free, and this is all data from the U.S. Census Bureau. Home equity. Now, we talk about being mortgage-free, but there is a massive amount of home equity that people are sitting on. I looked back at our forecast in 2022, the total tappable equity in the United States was $9.2 trillion. Today, where we sit through the third quarter of 2025 is there's $11.2 trillion in tappable equity. That means the average U.S. homeowner with a mortgage has $204,000 of tappable equity available to them. Now, you may be saying, what is tappable equity? It means that it's essentially all that is left over, but you still hold a 20% equity position in the home, and it's all of that excess that exists. And so that's a pretty substantial number that is also allowing more and more homeowners to say, I'm not going to be hampered for these life decisions by just interest rates. I'm going to deploy some of this equity to take that job or to move to that city or be closer to my grandchildren. Those are all decisions that homeowners are making. The other thing I want to point out is we often hear people say, well, what about foreclosures and delinquencies? Are people, late on payments? Are people struggling? And I wanted to pull this forward to you. Colorado sits at the 4th lowest state for percentage of non-current mortgage holders. And this is measured by foreclosure proceedings as well as delinquency. Only 2.42% of Colorado homeowners are delinquent or going through foreclosure proceedings. Now, a lot of people go back to the Great Recession and say, hey, we never want to go back there again. But the indicators on the inverse side of how challenged the market is does not exist. We're sitting in a really good position from all of that equity growth and price appreciation we had in our region. Now, employment and jobs is really what drives real estate. And looking across our region, we'll look at Larimer County first, employment's been pretty flat, but really it's been pretty flat nationally. It's been flat at the state level, and it's been flat across most of our counties here. So looking at Larimer County, a high in October of 2023 of 203,000 employed, and then currently in November, 198,000 employed. We're not seeing massive job growth like we saw during the really kind of rampant economy of the last 12 years in our state. Weld County, very similar trend. And also point out here, you see a missing data point. Well, that missing data point was due to a government shutdown where we didn't get data from October from employment. The other thing I'll point out here that a lot of the Bureau of Labor Statistics were very overstated. And there's been a lot of revisions to the number of jobs that have actually been added, and that changed a lot of the state as well as some of the national employment data. But we feel like we got a pretty good handle of where it is now. And the theme I want you to know is that employment is a predictive indicator of what the next 12 to 18 months is going to look like in our real estate markets. If we see sharp increases in jobs and employment opportunities across the region, you can expect that there will be sharp increases related to real estate as well. And so when you say, well, how are you predicting kind of stable or moderate growth for 2026? Well, it's because most of the employment numbers are relatively flat. They're stable. We're not seeing huge decreases, but we're not also seeing huge increases. Weld County was down just shy of 1% year over year, and then Boulder County was positive 0.15%. I want to go through Colorado's economic indicators. Now, this is reported by the Colorado Business Economic Outlook, the lead school of business. And this looks at both the 15-year trailing snapshot of where the state ranked and where the one-year snapshot of where the state ranked. And I put in green the key indicators that we're seeing improvement in terms of our state rating. And I'm also put in red some of the things where we're seeing decreases. Now, let me point out, when you look at 2009 through 2024, let's all agree that Colorado had it pretty good. We had a lot of incredible things going on, an amazing party that we really outranked the majority of all other states. In 2025, I want to point out there's some key things here that are positive signs. We're improving our rating on real GDP growth. We're improving our ranking on a very critical item, which is personal income growth, which ended at 5%. Per capita per income growth, we improved. That's at 4.3%. The unemployment rate improved as a state. We're at 4.2. And I'll also point out some of the strength of our region is how low the unemployment is in northern Colorado comparative to the rest of the state. And then go all the way to the bottom, which is the FHFA home price index growth. Now, some of you may look at that and say, man, Colorado ranks 50th out of all states. I'm going to ask you a question. How many of you had extended family that came and stayed with you during the holidays, or you went and visited extended family? Would you raise your hands? How many of you? Okay, so a few. So the rest of you, raise your hand for this. Did you have a peaceful, quiet holiday to yourself, or did you travel somewhere that was peaceful and quiet? Raise your hand. Yeah, so a few of you, I don't know what you did for the holidays. I liken it to this. Colorado experienced that incredible family gathering where there was so much fun, there was so much going on, and your house looked like a tornado. There were dishes, there were laundry all over the place. And then when everybody leaves and there's kind of this calm and you can kind of get back to just your normal routine and that feels pretty good. That's where Colorado's housing market is. We had one of the loudest, most robust family gatherings of real estate over the last 12 years, and we're kind of in that peaceful state where everything's just getting back to normal. And I think that's a good thing. So I want to talk more, but I'm going to turn this over to an expert in this area to talk a little bit about some of the financing strategies you need to deploy for 2026. And I welcome up our president of Group Mortgage, Jason Pfeiffer.
Thanks for coming out. As I was preparing for this evening, I went back and started looking at the previous forecast for the last few years. And I couldn't believe it's been 3 years since we've been talking about elevated interest rates. 3 years ago, we forecasted interest rates would be between 6% and 7%. 2 years ago, we thought they'd be between 6 and 7. Last year, more 6, 7. And I don't know about you guys, but I'm exhausted of all this 6, 7 nonsense. So if I could have you reach over to the person beside you, give them a high five, and hopefully we can manifest rates to be in the 5s moving forward. And I'm actually optimistic because I think rates will be in the 5s, but I wish it was just that easy. Because when we start looking at the data, rates aren't at a certain point for the year. They're in a range. Going back to 22, we saw interest rates from about 3.25 over 7%. During that year, they moved nearly 4%. In 23, we saw a move from 6 to over 7.75, 1.7 movement in that year. Last year, or in 24, 1.14%, but it was actually more dramatic than that because they went up and down and back up. And last year, we saw them just move from about 7% down a little under 6.25. And I say only because when you look back at the 50 years of data, in the average year, they move 1.4%. So I think when people look at forecasts and things like that, they don't take that into account. We look at one rate and we factor that in. So keep that in mind. Taking a deeper dive into what interest rates did last year, as I said, they started over 7%. We had a gradual decline and they ended that year just under 6.25. Our forecast was 6.3%, so pretty close. But as you see, there was some variability over the year, but I'll take the end result. A couple things that I wanted to point out in this graph is that 10-year Treasury. It started out the year at 4.67% and ended the year at 4.17. So it only decreased 0.5%. However, interest rates decreased almost 1%. And that tightening of the spread between mortgage rates and that 10-year Treasury is a very positive sign. Something that we've been hoping for and hoping to see for years. If that trend continues, it's going to make 26 a great year and a continued downward pressure. Second thing I wanted to point out in this graph is those red circles there. Those represent when the Fed rate cuts happened. And what you see there is in the September and October cuts, right after they cut the rates, mortgage rates went up. And however, if you look right before that, interest rates came down leading into the meeting. And why I mention this is we have so many clients that hold off and wait and they say, oh, the Fed's going to cut rates. Let's hold off for a minute. And then they call us and like, did rates go down? We're like, no, they went up, right? It's a difficult conversation because what's happening, and something I'll echo tonight, is real estate mortgage rates move on the news, not the action. So leading up to those meetings, it was widely publicized that the Fed was going to decrease rates. You can see they go down to that meeting, then the Fed comments come in that weren't quite as favorable, we see interest rates go up. The December cut was a little different. It was a little bit more uncertain whether they were going to cut rates, so it moved laterally moving into that, and we saw a little bit of benefit. So where are they going to be in 26? Well, looking at Fannie Mae, they think they're going to start in the low 6% range and get into those high 5s. Mortgage Bankers Association, they have 6.4% throughout the quarter, so they must not know the stats that you know about the variability of rates. And ChatGPT, which is everybody's expert for everything these days, has rates moving in the mid-6s down into the high 5s. However, I do think there's a good chance that all these people start to revise their forecasts. And that's because of the news that came out on Friday. And Fannie Mae and Freddie Mac announced that they were going to be buying $200 billion of mortgage-backed securities. And on that news, not on the action, interest rate immediately had some downward pressure. Recently, I've been reading articles that are optimistic and thinking that this is going to push rates into the low 5s. However, I'm not so certain that's going to happen. When I look at the overall mortgage market, mortgage-backed security market, we're talking over $9 trillion. Over $300 billion is being traded daily. So while this is definitely a positive sign and put downward pressure and we'll take it, I'm just not as optimistic that we'll see some of the low 5s that people are predicting there. Another thing I wanted to talk about and kind of geek out with you a little bit is the yield curve. And going back to 23, we had something called an inverted yield curve. And if you look at 6-month treasuries, they were yielding up above 5%. Meanwhile, 10-year, so if you hold your money for 10 years, it was more around 4%. So that's called an inverted yield curve. Fast forward to today, now those 6-month treasuries are only yielding in the mid-3s, whereas the 10-year is just over 4%. This is a very positive sign for mortgage rates for a couple reasons. One of it is it brings in the availability of an adjustable rate mortgage. And so we haven't seen a lot of those, but with those short-term rates being lower, you can shave off about 0.5%. This is a strategy that's always been used when rates are elevated. However, a couple of years ago, we didn't have that option because the short-term rates were higher than the long-term rates. The other thing is, as investors are looking to seek yield, because a 3.5% rate may not be that much when you compare it to the inflation, they move their investments further out on the yield curve. So they start buying 10-year treasuries or mortgage-backed securities, which can push down those interest rates in the year ahead. So hopefully that continues and something that I'm keeping my eye on. The last thing I really wanted to cover is the concept of timing the market. So many people, and I know everyone out there, they want to buy a house at the exact moment rates are at their lowest. And it'd also be really nice if it was when they had a little break in their job so they had time to move and do everything. However, the likelihood of all of those things coming together at the exact same moment is a little bit about the same as the Rockies winning the World Series next year. So the best buyers aren't timing rates, they're structuring their payments. And the reality is, and Brandon talked about it, is your home matters the most, right? Not necessarily the financing. So knowing that, what can we do? Well, some of the strategies we've been using for years is, first of all, interest rate buydowns. We have both permanent buydowns and temporary buydowns. Temporary buydowns, your interest rate might be lower for a year or two. Second thing that we're using, and Brandon's going to talk a little bit more about, is seller concessions. Utilizing those seller concessions maybe to use that temporary buydown. Obviously, people sometimes forget about the ability to refinance. And so we have a Refinance in 5 program right now where anyone that buys in the next 5 years can refinance without paying any underwriting processing or appraisal fees. And so they can buy the home that they want when there's the inventory. And then if they see one of those dips, they can refinance. The last one is the one we just talked about, is adjustable rate mortgages. If you are at a little blip up on the interest rates on the 30-year, moving into an ARM can save you that 0.5% and waiting for those rates to come down. And in fact, looking at the market right now, if you could combine a 3% seller concession and we're willing to take an ARM that's still fixed for maybe 5 or 7 years, you could get your interest rate into the high 4s. Speaking of the timing of the market, there is a cost to waiting. So we saw earlier that we had rates kind of dip into those 6% range. But Brandon showed that slide where we have a lot of people over 7% right now. And they were, every time we'd call them up then and ask them, they'd be like, oh, we're waiting for rates to go just a little bit lower. Meanwhile, they've spent 2 or 3 years paying that higher rate at a cost. So there is a cost of waiting there. And for those of that are looking to, purchase a house, are you really going to hold off on being the home that you want to be in for an extra quarter or half? So there's a cost to that. The last thing that people do is timing the market that we hear a lot is they're waiting for some national media or some national headline to play out. But I know if I talk to almost everyone in this room tonight and be like, do real estate prices operate national or local? Right? Real estate's local. It might even be hyper local. But people are pausing their decisions on what to do based off of a national headline. And I'm not sure I understand that logic. What I think would serve you much better is to talk to the group mortgage team. We have the group of loan officers here that all average over 20 years of experience. And I think they would be able to guide you through the strategies, whether it be refinancing or buying a home, to give you a much more informed decision moving forward. So with that, I'm going to turn it back over to Brandon and talk about what the sellers need to know. Thank you.
Thank you, Jason. I was just thinking your kids are going to be so proud of you. They can't wait to see that recording. This year, changing the theme a little bit, instead of just focusing on stories, I wanted to focus on what do you need to know. Now, many of you are sitting in this room as homeowners that have considered selling, might be considering selling. Many of you are buyers. Many of you are investors or own portfolios of properties. So what do you need to know in this marketplace to be best prepared? So let's start with sellers. The first thing you need to know is you need to know your market. This is critically important, and we talked about this last year, but this is even more important because so many sellers that embarked on the marketplace this year did not really understand the market that they were headed into. And, we just came out of this period of time of this hyper sellers market where people get conditioned into this behavior of, I could price based on what my neighbor got or what was happening or what I thought was happening with multiple offers. The reality of where we are today is we have certainly transitioned. we have transitioned, in many cases, through the normal market into a little bit more of a buyer's market. Now, this ebbs and flows based on the year and based on the seasonality, but really, how do you define this as a seller? You need to have very, very detailed strategies with regard to pricing, with regards to timing, with regards to concessions. All of these things need to align perfectly, and they are very dynamic. As you've probably seen in your neighborhoods, a lot of properties come on the market, sometimes there's no properties. That movement changes the way that sellers need to be positioned. So in a normal market, by definition, where prices have been consistent over time, in order to best position yourself, you need to price with or slightly below the market in superior condition and consider incentives that are going to allure that buyer into wanting to purchase that property. In a buyer's market where prices are declining, maybe not significantly, but you can see price pressures, you really need to consider pricing below the market to offset the negative effect that time has on prices. And so understanding through an advisor that can help guide you is critically important, because one of your greatest expenses is what we're going to talk about here in a second that many sellers missed in this last year's market. So this is Zillow's Market Heat Index. And what it is, it's a pretty good just reflection. You can look at pretty much any real estate market across the United States, and it's measured on 3 categories. Number 1, what is the activity or viewers, online viewers for real estate in that region? Is it increasing, decreasing, or is it neutral? Number 2, how many properties have had price reductions in that market? And number 3, how many properties are receiving offers between 21 and 30 days, which helps measure. And they come up with a metric here. And it's not an exact science. Many of you have probably heard the long mythology that, hey, if there's 6 months worth of available inventory, that represents a neutral market. Anything more than that is a buyer's market. I think that methodology has changed in our current conditions. But by definition here, Fort Collins has been in a little bit more of a buyer driver's seat mode, where buyers are a little bit more in the position of negotiating power with sellers. And that ebbs and flows based on the seasonality of the market. So we can come back out to a neutral market. It might in some local markets get a little bit more seller focused because there's a lack of inventory. But you need to really understand the hyper-local dynamics. Let's look at Greeley. By definition here, a little bit in a neutral market. And then going down south to Boulder, a longer period of time as definition of a buyer's market. So it's really important to know the market that you are in. And as I mentioned, the greatest expense that sellers have is in the market right now is the money that you do not make. And oftentimes it's because of poor timing, poor pricing strategy that is getting sellers in a bind. You see the number of weeks on the left, which essentially when properties languish, we start to see a direct correlation in the reduction amount or the amount of concessions that seller has to offer in order to entice a buyer to purchase. It's not an exact number, but you can relatively see that there is a diminishing return in terms of equity that a seller has if they miss time or don't have an appropriate strategy. The other thing, though, to consider for a seller here is when Jason talks about rates and how rates have impact buyer decisions, is the enormous amount of cash transactions that continue to happen in the marketplace. Nationally, the National Association of Realtors reported that this year, record high, 26% of U.S. home sales were all cash transactions. Taking a look at how that shaked out for our area, Larimer County set a record this year of 24.5% of all transactions were cash purchases, no mortgage. Weld County, demographics, so this was 12.4%, and the demographics suggest younger families, more people need to use mortgages to be able to purchase, so not as much cash activity. Go down south to Boulder County, nearly 30%, 29.1% of all purchases were cash purchases. So we have a lot of sellers who, if you just looked at the dynamics in the market and said, well, we got to be really aggressive on our price because interest rates are higher. Well, you might have 30 or 40% of your marketplace that is buying in cash that doesn't really matter. So having an expert that can help you understand the dynamics of your local market and how you need to be positioned is really important. One of the big questions we asked ourselves this year as a brokerage is, there's a lot happening with seller concessions. And what impact are they having on the market? And what impact are they having with our sellers? So we now produce a quarterly report that goes through and does analysis on each one of our markets of what is happening with sellers' concession, because it's not just about price. Typically, negotiations deal with 5 key points. They deal with price, they deal with dates, terms, inclusions, exclusions, and contingencies. And concessions are a big part of that. So to give you some highlights, this is for the fourth quarter to kind of show you how many properties are using concessions and what amount. This is Fort Collins, and I'll go through some of the data in more detail here, and then I'll fly through some of the other areas. But in the fourth quarter, 416 total sales between resale and new construction. 205 or 49.3% of those offered a concession. The median concession amount was $8,000. Now, if you just look at that resale line, if you're a resale seller, that's really valuable information to know, because if you're competing against other listings in your marketplace, you're not just competing on price, but you're also competing on what has happened with regards to what buyers are getting in concessions. The other point I want to make here is new construction. We only have optics into what is in the MLS, so we don't have all of the information because some of the new construction sales don't ever make it into our MLS, but this gives us a pretty good reflection of what builders are offering in that marketplace. So for Fort Collins, a median concession amount on 50% of the properties was $7,500. We look at Loveland, it's pretty much the same. About $8,000 was the median concession amount, and that was offered on 57.3% of the closings in the fourth quarter. We go to Windsor, 56.5% of the resale properties offered concessions of a median amount of $8,500. Greeley, 65.6% of fourth quarter home sales had a concession of a median amount of about $8,000. Timnath, now this is a point I want to make that is really important. If you live in a community that has competition of new construction, Johnstown, Timnath, certain areas of Greeley, you really need to pay attention to this, because you're not only competing with those other resale sellers, you're oftentimes very much competing with the new construction. So Timnath, for example, 47.8% of properties that were resale had a median concession amount of $10,000 in the fourth quarter, and the median concession amount for new construction in that market was $25,000, and that was offered on 72.2% of those sales. So we offer this report. It's great data. Your group realtor can guide you through this on a very hyper-local basis. One of the great things about the report is it's broken down by price range, because the concessions do vary by the different price ranges, between $500,000 and $700,000 or over $1 million, and you want to know how that impacts each market. Now, let's shift gears a little bit and talk about what do buyers need to know moving into 2026. There's a big question: are you ready? And this isn't the are you ready to get on the starting lines, because all sorts of things are happening, but I do believe that is a part of that. This is more about being prepared to enter into the market. Gone are the days and ages of just, somebody decided, I actually think I do want to buy a house, and jumping in the car and going out and looking at properties and it just happening. Buyers need to be much more savvy and strategically positioned to garner the benefits that are out there and the opportunities that exist. And what I mean by that is there are multiple considerations that buyers need to be prepared for. Number one, they need to be financially approved. They need to understand and build a blueprint of what it is they are going to be able and capable of doing, and that's not just about price and interest rate. This is also about understanding concessions and what is happening. That concessions report I just referenced is important because a buyer may say, I can't afford that market, but underneath the surface, if sellers are offering concessions of that amount, that buyer may have opportunities with new construction or with resale having negotiating power. Oftentimes what buyers overlook, though, are a lot of these other hidden things, like HOA fees, property taxes, properties that are in metro districts, inclusions that sellers are offering. And then insurance is a big one. It used to be an afterthought, but it is no longer an afterthought as insurance premiums have continued to grow. And so buyers need to be strategically prepared. So if you're thinking about purchasing, don't just wait to that last minute, because I do believe there is going to continue to be surge moments in this market where we see rates improve, we see inventory look great, and buyers are going to jump into the market and take advantage, and we continue to kind of see that surge happening, and I don't want buyers to miss those opportunities because they're not prepared. The second thing is this idea of shadow inventory. Silently behind the scenes, what has been building is there is a lot of opportunities that many of you cannot see because they're not currently active listed properties. Many sellers embarked on the market only to find out that they didn't have the right strategy, so they retreated, they withdrew their properties, or they expired and they're sitting in their house. Oftentimes their desire to move has not changed, but the market terms of what they thought they wanted were not acceptable, so they retreated. There is a growing amount of shadow inventory building behind the scenes that I think you'll continue to see sellers say, interest rates are getting a little bit better. It seems like buyers are embarking on the market. I think it's time. Now, being able to access that is important. Many people can't see that on Zillow. You can't see that on Redfin. You can't go out to all these aggregators. Real estate professionals know what has come on the market, what is underneath the surface, and can go and find some of those opportunities strategically for buyers that they may not think exist. But the inverse of that shadow inventory is one of the other things that you need to point out, and that is shadow demand. There is a huge amount of people who want to buy, but the terms and affordability, whether it be insurance, interest rates, or whatever, have not been in their favor. But as things improve, that's where more and more buyers emerge. If more and more buyers emerge and there's not adequate inventory, well, we're right back in a position where the people who waited didn't get the prices where they were. They're now competing with more buyers. And I think this shadow inventory, shadow demand is something that buyers need to pay attention to in this marketplace. Let's talk about what investors need to know. Many of you in this room own properties, portfolios of rental properties, and I think there's a few key things I want to point out this year. Number one is landlord-tenant laws and regulation continue to get more and more complex. They many times are very pro-tenant. And that's not a bad thing, but landlords, the complexities and keeping up with the regulatory landscape continues to be more and more difficult. Many sellers have said, you know what, or many property investors have said, I'm tapping out, it's getting to be too much. They're either liquidating or they're moving to other investments. But I think strategically, if you're not able to keep up with that, professional property management is an important consideration because many have experienced rent growth and appreciation, and keeping up with the complex legal landscape is getting more and more challenging. What to expect in terms of rent growth for our region for 2026? Very similar to real estate, flat to modest growth. We're not seeing massive rental increases. We still have inventory to absorb in multifamily of apartments. Single family and all of these are just going to see continued kind of flat to 3% growth changing by the various region or area. And most of that is because owners are reconciling increases of HOA fees, insurance premiums that are increasing, and property tax adjustments that they're many times having to pass through to those tenants. The third thing I want to touch on, because I want to revisit this from last year, something we were watching in 2025, was ADUs. For those of you who don't know what an ADU is, it's the accessory dwelling unit. It can either be attached as a separate unit on a single-family residence property, be a part of it like a above garage or a garage conversion or a basement conversion. And the state passed, obviously, the mandate of ADU compliance by all cities, towns, and municipalities to try to combat affordability. Now, there is a future opportunity with ADUs, but what is really hampering the adoption is the high construction costs currently. Most builders will tell you it's somewhere between $300 a foot to $1,000 a square foot to construct an ADU. I went back, and this is not an exact number, so please do not quote me on me, but I went back through every filing through Fort Collins this morning, and there were less than 50 ADU filings with the city of Fort Collins. Now, there certainly were some, but that high construction cost is putting a damper on the availability and the opportunity that ADUs create. There's also a lot of changes amongst the different towns, cities, and municipalities around permitting costs and impact fees, and it varies by area. But I do think this is an interesting future opportunity for current property owners, investors, to look at ADU and the opportunities it provides in terms of rental growth. The last thing I want to talk about is selling tax strategy. One of the commonalities we hear from the majority of investors is they were not prepared when they got to the point of wanting to potentially liquidate or sell those investment properties. That could be liquidation tax implications. That could be the consideration of owner carry financing to essentially pass that property on and get out of their ownership position. But a lot of them also, a lot of boomers are aging. They hold residential real estate as an investment, and they're considering inherited property pass-through. Tax laws change and are very dynamic. And I implore investors to strategically sit down with a licensed tax consultant to strategize your exit or your pass-through of those properties, which is often commonly an afterthought that we continue to see. Next, I want to jump into the Boulder benchmark. This is many people's favorite part of the forecast, and it's where we compare the same property across 3 distinct areas. And it is a property that was constructed by Wheeler Construction in Greeley, in Fort Collins, and in Boulder. They essentially look the same. They're about 1,000 square foot, all brick construction with a single car garage. Many of them had converted basements, etc. But we'll go through this. We use this as a pricing benchmark to see how have the markets kind of changed over time, what's happening Boulder with pricing, because it's a forecaster of about where does Fort Collins see itself in 10 years, and we've kind of followed suit along the line. So let's take a look at our Boulder benchmark property in Greeley this year. It was 2642 12th Avenue. It was 2,052 total square feet, sold on, the 9/24/2025 at $368,000 or $179 a square foot. Our Fort Collins property, as you see, very similar. 2229 Purdue Road, 2,074 square feet, sold on February 7th, 2025 at $585 or $282 a square foot. And then going down to Boulder, essentially the same property, 355 South 38th Street, 2,526 square feet, $960 or $380,000 a square feet. So same property, 3 distinct areas. This is how this has trended over time. And it's really interesting. We talked about, not a lot of price growth, and you see that reflected. We saw a little bit of growth in Fort Collins year over year. Boulder was down slightly, and Greeley was flat down a little bit slightly. But this just provides a fun kind of metric of where do we track with the same property in 3 different geographical areas. Things to watch for 2026, things that we are paying attention to that we think could change the dynamics of our area or improve things. The first thing is USDA and the U.S. Forest Service. So many of you may have been following the headlines, but USDA in July announced the relocation or consolidation of their headquarters in Washington, D.C. There's not many indications about how many jobs, but there's been a strong indication of relocating many of the USDA staff to regional hubs, Fort Collins being one of them. And one of the things in that announcement was they would be centralizing 9 field offices of the U.S. Forest Service into Fort Collins, Colorado. Now, don't know what will shake out. It could be 500 employees, it could be 2,600 employees, but this does mark something that we are paying attention to for its impacts and economic impacts on our community. Because as I said before, jobs create real estate growth, and that is an important one to watch. The second thing is going out to Greeley, the Cascadia and Catalyst project. So a large mixed-use project that is anchored with a new sports arena that is slated to house the Colorado Eagles, a new water park that just had announcements around Mattel signing on to be a sponsor, the kids' toy brand of that water park, a hotel, and lots of other mixed-use retail. Like any large development, this still has hurdles to pass in terms of public vote, I believe at the end of February, but it's something we are paying close attention to because this is a large-scale, large meaningful impact if it does go through for what changes out in Weld County and in our region. So something to pay attention to for 2026. The third, I will say, is federal government housing initiatives. As Jason alluded to, the announcement of Fannie Mae and Freddie Mac purchasing $200 billion in real estate bonds, there is a lot of attention on, we've heard things like 50-year mortgages, portable mortgages, we've heard about taking strong stances and initiatives in housing. That's something we are certainly paying attention to because like Jason said, real estate markets move on news, not necessarily on the action, and there seems to be a lot of news in the news cycle about housing in general and housing affordability. So this is something we're paying very close attention to. The other thing that didn't make my slides that I'll make mention, because everybody asked, my kids asked me this more than anything, what's happening with that Amazon facility out there? And does it just employ 5,000 robots, or are there actually going to be humans in there? The Amazon facility, as you may have read in BizWest or others, is slated for a late 2026 opening. Yes, it employs a large number of robots, but does have an impact on employment with potentially 1,000 all the way up to 3,000 jobs. And so any job or employment growth is substantial and I think newsworthy for our region. So some things that we're paying attention to. I want to end tonight by saying a couple of things. This is an important year for the group, Real Estate. And the group was founded in 1976 with 12 founding members with a goal and a desire to serve these communities with an expert level of trust and to really be good tenants of our communities. And this year marks 50 years for us. Our birthday or anniversary is actually Valentine's Day of this coming year. And more than ever, we as a company are committed and looking forward to our next 50 years. Oftentimes, I don't think the group does as good of a job as it should of tooting its own horn. And I'm going to do that a little bit tonight. The first thing I want to say is the group grew market share in every single Northern Colorado market that we served this year. We grew market share in some really key meaningful areas. I saw one this evening that of properties over $2 million in Fort Collins, we had a 45% share of the market. We're involved in one of every 4 transactions in Fort Collins and a majority of our large areas. And so we thank you for your trust. But to me, it's not about those metrics. Those are important, and I think they're meaningful because you've trusted us to help you and guide our region with regards to housing. But the things that I am most proud of our company for, that I think many of you know the group for, is our community impact and leaving a legacy of service. Community is one of our founding principles. It's one of our core values. Group Gives has awarded over $1.3 million in community grants supporting housing stability. That is our nonprofit initiative, our endowed nonprofit. We've contributed as a group, not by raising money outside, but raising money in our walls of $6.5 million to United Way over the course of our workplace campaigns. This year, we were recognized as the recipient of the Colorado National Philanthropy Day Award for large business in the entire state of Colorado, a huge recognition that I am so proud of our partners for all of their willingness and desire to help our communities. We're proud sponsors of countless local nonprofit events and community organization, and since 2014, our group partners have deployed in our communities to celebrate Group Gives Back Day, where we volunteer for local nonprofits across that region. To me, it's not about the results that matter, it's about the impact that we leave behind, and I'm really proud of the 50-year legacy that our company has left and the marks it has left, and I'm looking forward to the next 50 years. Thank you. We're at the end of the presentation, but we're not at the end of the fun. You can access all of the materials, everything I showed, all of the reports, the slides, the video recording. If you want to share this with somebody, if you want to hear Jason say 6'7" to prove it to your kids, that will be up on that same link. We have some amazing builders who are here represented tonight. We have amazing partner businesses in our group Mortgage Guaranteed Title Group, the Source Property Management, Collective Insurance Group. We thank all of them for their support. If there's anything you heard or you want more information, please go stop in and visit with these amazing companies and people. If you want to follow along throughout the year with us, you can subscribe to our monthly Real Estate Insider, which is a printed or an emailed newsletter. We'll keep you abreast of all the changes and dynamics impacting our region. The monthly market reports, if you want these stats on employment, on median price, and as well as that concession report, these are all things that we offer to you. Just please visit with one of our group real estate brokers, your broker, and they'll make sure you're signed up. And on behalf of me, I want to thank the Embassy Suites and their incredible team. And I want to give a special shout out to our marketing team who puts on this incredible event. And I want to thank all of our partners, our group realtors who bring you their customers, and all of our community partners, business friends, the media outlets. Thank you for being here. Thank you for entrusting us. I hope you guys spend some time mingling with each other and enjoy your drinks and hors d'oeuvres. And let's have a great night. Thank you for being here.